Hey guys, so for today's lesson, we are going to be going through some models for liquidity. I'm going to be getting into doing three bullish models that you're going to see a lot of the times in the market. And we're going to also be going over three bearish liquidity models as well. Okay, so videos are not going to be long. I'm just going to run through each model very quickly to show you what to look out for in terms of how are we actually thinking the same as other traders within the market. For example, if you do trade smart money concepts, ICT concepts, then you would you would kind of see the similarities that you'd have psychology wise before you are getting into a trade that is very similar to breakout traders, supply and demand traders, trend line traders. So I want to kind of go over these models to show you guys how you are essentially trapping yourselves into getting into the market with the majority of the buyers and sellers in the market and how you are essentially being that liquidity as well. So this is the first bullish liquidity model. I have this drawn out right here. And like I said, we'll get into the charts a little bit later when it comes to actually putting these strategy together, but I want to lay a foundation out as well as an understanding of exactly how liquidity is trapping a lot of traders within the market and how you're able to look at the market from a psychological standpoint, and really pay attention to price action and understanding true market structure and the reason why price drives based off of liquidity. So with this first bullish liquidity model, we do see that price had broken structure right here. We created a high. We then broke structure to the downside. We came up, we had some sort of retest, and we also broke structure again, creating a low, and price is coming up and up. And so this is, like I said, um, oh, sorry, excuse me. This would be a bearish model. Let me go ahead and change this. Yeah, this would be a bearish model. Okay, so this model would be for sells. My apologies. So with this model, like I said, we have our break of structure here, created a high, another break of structure here, created a low, and essentially we have a trading range, right? So we have a trading range from this high into this low, and we'll get into, if you don't know how to find a trading range or you're not familiar exactly what is a trading range, then we'll get into that as well, understanding more market structure and trading ranges and how to find them and identify them. But for now, this is the models that we're looking at. So I want you guys to pay attention to this when we are looking for a bearish bias right here. We're looking for a sell within the market from this point on. I want you to pay attention to some fake moves within this structure. So for one, a lot of people, especially if you're the type of trader where we have a break of structure right here, if you're a break and retest trader, you would automatically assume that your entry would be somewhere up here, right? We have a break right here to the upside and then we broke back down. But a lot of people are essentially looking for some sort of retest here. If you are a supply and demand trader as well, this is kind of an area that you would look for reactions at, correct? And then we also do have people that trade OBs. Like I said, if you are a smart money concept trader, you will be looking for the same pattern as well to kind of sell up here. Now, this becomes tricky because we can kind of see a little choppiness right here that the market kind of did before we pushed up into this area, waiting on reactions for a potential sell. So what I will say, when we are watching price action in live market as this move and price is creating this type of pattern in the market live, you want to understand the psychology behind this and a reason why price is going to drive to this area where we can look for sell-offs. So we see because normally people, when they see this right here, like I said, we have a break of structure. So automatically another break of structure right here, people are going to sell from this area as well, right? Break and retest traders. They're going to sell from this area automatically, right? So they're going to sell. They're probably going to hold their positions. Although price had created a low here and came back up, they're more than likely going to hold their positions depending on the type of trader that they are. But let's just say we're sticking with being on the 1 hour right now. So they're going to go ahead and get into their positions here. And then we see that they get into their positions here. And then we do see price coming back up for another retest, right? So they see this again. And they may want to get into a new position, or, traders, new traders are going to come into the market and look for a new position as well. So they're going to want to enter this position. Now, price does this again where we come back down, but this time price does not break structure, right? Price does not break this previous low. And a lot of people don't pay attention to that. And so what happens is, because it doesn't break this low, people are thinking, okay, well, it didn't break this low yet, but eventually it's going to, right? So then we have this area right here. So people are automatically going to want to enter because they see price reacting at this area as well and heading down. So they're going to want to get positions right here. This is for the break and retest traders, as well as the supply and demand traders. They could be looking at this structure on a lower time frame. So, obviously, like I said, let's stick to the 1 hour time frame. We're going to stay on the higher time frames right now. This is a higher time frame viewpoint. So like I said, people are going to drop down to lower time frames and see that these setups are valid, and they can be valid based on the type of trader you are. So because I am a scalper, just know that if these positions do come into play, more than likely I will take them, but I understand based on the higher time frame that I will not be holding these positions. I am a scalper, so I am not going to hold these positions no matter what. So like I said, it depends on the type of style that you are, but this is my scalping strategy. So we're not going to hold when we see these. So we can get these nice reactions at these areas and we can go ahead and close out. But I want you guys to know the overall psychology of this and understanding that these are not positions to be holding, as long as we know where we are on the higher time frame. So, and as long as you know where you are in the higher time frame, you can get into positions like this. You can ping pong the market back and forth as long as you understand liquidity and how it flows. So as we're seeing people getting into their positions right here, what has happened with all these supply and demand traders, with all these break and retest traders? And we even have those traders that use Fibonacci, right? We have these people coming up looking for a retest. Oh, it hit the 61.8, stuff like that, the 50%. So we got the Fibonacci traders in here as well, waiting for their fib retracements. And we also have trendline traders. We have trendline traders right here. This is a trend line, correct? So we have trend line traders getting into their trades right here. So we have everybody getting into their trades right here. And we also have smart money concept people that look for OBs, they look for breakers. And I'm pretty sure we have some imbalances right here. If we were to drop down to the lower time frames, you would find some sort of imbalance in there, some OB, a breaker. And everybody is getting into positions like this. So everybody is getting in their positions at this area right here. And so this shows me that this is liquidity, right? Because like I said, liquidity is transactions. It's the order flow between buyers and sellers. And so once we understand this, we see that everybody in the market, all types of traders are getting into this move. What will happen? Obviously, the banks will see that multiple people are getting in right here, and they'll go ahead and drive price up, take out this liquidity, and go ahead and tap into a POI that's higher. This liquidity is essentially feeding a higher time frame POI. Always understand that if there is liquidity within this area, it is feeding into something higher. And that's exactly the position that you want to enter. You want to enter into the position that is higher from where liquidity is being fed into. All of this is feeding this area right here. Without all of this, if there was no built up liquidity down here, this point of interest up here would be invalid. So the only way that this would be a high probable setup is if there is liquidity, if there is created and engineered liquidity right below something, right below a POI that's feeding into it, that makes it high probable. It makes it a high probable trade. But if you have nothing down here, it never created any of this, and it probably just had one break retest, came back down, and continue to break lows, then that is not high probable at all. Then you would probably have to have found an entry somewhere low and waited till some sort of liquidity was created and built up in the scenario. So it does this, and you can go ahead and back test this as well. This model shows up all the time where we have this right here. And this would also be considered as like kind of a consolidation on the lower time frame as well. So you want to be careful for this because, like I said, look how many people are in this. We have trend line traders, we have break and retest traders, we have supply and demand traders, we have smart money and concept traders. And it's so funny because you would think that they're trading smart money, but they're actually getting to positions, the same positions as everybody else. So how is it smart money when you're getting into the positions as everybody else, correct? So we want to recognize this and understand that it's feeding us into something higher, and that is what makes that position, that entry a lot more high probable. Then you would have your entry. Once everybody gets taken out of the market, you'd simply have your entry up here. You can have stops to your high. And because we are bearish, we can go ahead and target the low. And this would be your entry point. But understand this, like I said, it's all the psychology behind it. You want to understand how price is moving at these areas. You want to see, okay, it's not breaking highs, it's not breaking highs, it's continuing to break lows, but these break of structures aren't valid enough because this high did not break this low. So it makes this high weak. You really want to pay attention to how price is approaching certain POIs or areas in the market that you're looking for reactions at. So this concludes the first model one, and we'll go ahead and move on to the second model.